Your phone lights up. Your banking app opens. Your balance is still there. Good. Now imagine this isn't just you. Imagine millions of people doing the same thing. Same minute. Same calm panic. Nothing dramatic yet. No alarms. No sirens. Just taps on glass. This is the moment everyone assumes money becomes real. And this is where the story quietly breaks. Because what you're looking at on your screen isn't cash. It's a promise. And promises behave very differently when everyone asks for them at once. This matters now because we live in the most digitized money system in human history. Most money no longer exists as paper. It exists as numbers that move faster than thought. We swipe, we tap, we trust, and trust is stable until it isn't. The uncomfortable truth is this: modern money only works when most people don't touch it at the same time. That's not a conspiracy. That's the design. Let's slow this down. When you deposit money into a bank, it does not sit there waiting for you. It doesn't rest. It doesn't sleep. It gets reused. Your money becomes someone else's loan, a mortgage, a car payment, a business expansion. This isn't secret. It's called fractional banking. But the name hides the tension. Banks are allowed to keep only a small fraction of deposits as actual, immediate cash. The rest is invested or lent out. Why? Because if they didn't, the economy would crawl. No loans, no growth, no movement. The system assumes something very specific about human behavior. Most people will not ask for their money at the same time. And most of the time, that assumption is correct. Until something cracks. Here's where digital money changes the game. In the past, withdrawing money took effort. You had to go somewhere, stand in line, ask a human. Now it takes a thumb. Speed removes friction. Friction used to buy time. Time used to calm fear. Today, fear moves at the speed of a notification. Picture this. A rumor spreads. Doesn't even have to be true. Maybe a bank made a bad investment. Maybe a headline sounds worse than it is. A few people withdraw just in case, then more. Then influencers start explaining what's happening. Then group chats light up. Then silence from the bank feels louder than any confirmation. This isn't mass hysteria. It's rational behavior. If you think other people might pull their money, the smartest move is to go first. That's the trap. Because individually rational decisions become collectively destructive. The bank doesn't collapse because it was empty. It collapses because it was a liquid. A liquid doesn't mean broke. It means slow. Your money exists, but not right now. And not right now is unacceptable when fear shows up. Here's the uncomfortable math. If even a small percentage of depositors demand full withdrawal at once, the system freezes. Not because the money vanished, but because it's scattered across time. Long-term loans can't instantly become short-term cash. You can't turn a 30-year mortgage into today's withdrawals without selling it fast, often at a loss. That's when things escalate. Banks start selling assets quickly. Prices drop. Losses appear. Confidence erodes. And suddenly, a liquidity problem becomes a solvency problem. This is where the illusion breaks. Most people believe banks hold their money the way lockers hold bags. They don't. They hold obligations. Now zoom out. Banks are connected to other banks. Loans are packaged. Risks are shared. So when one institution stumbles, others tighten. Lending slows. Payments take longer. Credit lines vanish. Nothing dramatic, just delays. Delays are how modern crises start. And here's the irony. The more digital and efficient money becomes, the faster panic can travel. Technology solved inconvenience. It did not solve human behavior. Now let's talk about the safety net everyone assumes will catch them. Governments ensure deposits. Central banks stand ready. And yes, those systems are real, but they also depend on timing. Deposit insurance works if withdrawals are orderly. Central bank liquidity works if confidence returns quickly. What they cannot do instantly is convert the entire digital promise layer into physical reality, because that reality doesn't exist at scale. There is not enough cash. There never was. And that's not a flaw. Cash is inefficient, risky, expensive. The system evolved away from it on purpose, which leads to a strange contradiction. The more we demand money behave like a solid object, the more it behaves like a fragile network. Most of the time, this fragility is invisible. You pay for groceries. Your rent clears, your salary arrives, everything feels solid. Until suddenly, everyone remembers the same truth at once. Money only works because we agree it works, and agreement is not guaranteed under stress. This is where hype and reality collide. We talk about bank balances like stored wealth, but functionally, they are IOUs backed by trust, regulation, and time. Time is the quiet hero here. Time spreads withdrawals. Time smooths fear. Time allows assets to mature. When time collapses, systems snap. That's why financial crises often look sudden. They aren't. They're slow systems meeting fast humans. And digital money made humans faster. Now consider the bigger implication. If a large enough shock hits economic, political, or technological, the question isn't, is there money? The question is, can promises be honored immediately? That's a very different question. This isn't about banks being evil, or governments being incompetent. It's about trade-offs. We traded physical certainty for speed and scale. We gained efficiency. We accepted fragility. Most days, it's worth it. But it means the system is always one confidence shock away from stress. And confidence isn't controlled by spreadsheets. It's controlled by stories. Which brings us back to that moment at 9:07 am. You open your APP. The number is still there. But what you're really trusting is that everyone else won't open theirs at the same time. That trust has held for decades. Until it doesn't. So here's the question to sit with. In a world where money moves instantly and fear moves faster than facts, can a system built on delayed promises survive real-time panic? Or does digital money require a new kind of trust, one we haven't learned how to protect yet?